Today's Overlooked Stock is a software winner. George Tsilis is looking at progress for us, not just generally, but as we saw in the stock market, but in this company, George, which apparently had a great earnings.
Yeah, in fact, if you look at the stock, it's actually performed well post earnings, but it's been down over the last 6 months or so, alongside with the market, particularly down over the last 3 months. But interesting company. It's a company that's been around since the early '80s. It's a Boston, Massachusetts company, so there's an MIT kind of connection here as well. But they are basically focused as a software now in developing AI-powered applications, development operations that are automated, as well as essentially decision analytics automation. The other thing is they've also made a significant amount of acquisitions in the last year or so, where they've now acquired a secure data and file transfer based business, which they actually denoted in their conference call that they're actually starting to see some accretive results on that or from that. But overall, if you look at the earnings, which were reported yesterday afternoon, they did post a significant beat by about 25 cents, coming in around $1.31 versus the $1.06 estimate. Now, that was expected to be slightly lower, or actually quite a bit lower than last year because of acquisition costs. So they actually came in ahead of that number, but it was only higher by about 5% year over year from an earnings growth standpoint. Sales posted a beat, 29% increase at $238 million. But the company also denoted for the last fiscal year, including, of course, the acquisitions, that free cash flow margins were over 10%. And overall guidance was revised slightly higher for the full fiscal year in both sales and earnings. So this is a small company. It's around $2.5 billion in terms of market cap. It does compete with some of the larger players out there, which include Microsoft and IBM. What I did notice is that if you look at the forward estimates for growth in both sales and earnings, they're expecting sales, and these are, again, the combined units, around 12.5%, with earnings around 23%. Both these numbers are actually significantly higher than their 5-year average. So for what it's worth, I think this is a company that's gone through quite a few acquisitions. In fact, they've lost some profitability margin because of that, but it looks like their growth strategy may be accretive going forward into 2025 and 2026 based on their acquisition strategies.
All right. Well, seeing the stock move higher on an acquisition-based kind of growth to some extent is interesting. Mm-hmm. I mean, the last earnings, the company got trounced. The previous two before that were pretty good. Yep. So it seems like analysts have had a little bit of trouble getting their head around this business model.
Yeah, it is. And there's the key. There's always a caveat somewhere. There's no real free lunch anywhere. Particularly, there's a challenge with the balance sheet on this one, because irrespective of the fact that there's market cap at around $2.5 billion, they do have about $1.6 billion in debt. So they have used debt to finance these acquisitions, which of course saves the equity holders. But the combination of the two, the ratio-wise, one would say maybe it's a little bit large compared to maybe some of their peers. I think that's why it's what has created sort of a drag on the stock. But for what it's worth, I mean, they are expected to grow their EPS, like I said, 23% on a forward basis, sales at around 12.5%.
Yeah.
It's making some nice recovery on earnings, but it still has quite a bit of debt compared to equity if you were to look at it relative to some of its smaller peers.
It seems like with the acquisitions or just going forward, once it's baked in, the analysts are looking for growth up to 35%. If this thing really takes off. So interesting. And to the point on debt, I get that. But, right now the market is looking for kind of tech-specific stock heroes. So maybe the earnings are good enough.
Well, it could be. And like I said, it's a small cap company. I did notice also there's quite a bit of short interest in the name, about 12% of the free float. So for what it's worth, like I said, if they start to demonstrate some continuous growth, and that might be not necessarily until the next quarter, there could be some short covering based upon the high float as a percent of total outstanding shares. So that's just something else I looked at or picked up on. But it's not obviously a top-notch technology firm in the software space, but nonetheless, it's certainly one that looks like it's moving in the right direction. But it's probably not going to manifest until at least another quarter or maybe even two.
Okay. All right. Thanks, George. Good eyes. Good find. Okay. PRGS.